We rolling? Perfect. Hello and welcome, everyone. We are Voyage Bicycles, the first of its kind 3D printed custom bikes. This is a little bit of what we'll be going over today. I'm Bennett Rossi, and I'm here with Sophia Riccio, Ellie Butel, Alexander Orloff, Wesley Erling, and Thomas Lutz. Let's start with our vision and mission. At Voyage Carbon, our vision is to inspire, encourage, and excite riders of all kinds. We're not just building bikes, we're building confidence, freedom, and a sense of adventure. Our mission backs us up. We're committed to delivering top-tier carbon fiber bikes designed for each type of rider. Whether you're riding pavement, hitting the trails, or cruising the beach, Voyage Carbon fuels your ride with quality and excitement. Next up, our fleet. We have 3 flagship bike models, each of which improved upon every year. Each of our bikes is named after a NASA mission because we're shooting for the stars in both design and performance. The Apollo is our speed demon, built for road racers who want to go to the moon and back fast. The Endeavor is our rugged mountain model, ideal for trailblazers looking for control and hang time. And the Rover is our recreational bike. This is designed for everyday fun with an out-of-this-world feel. Every model represents the same bold, forward-thinking design that defines Voyage Carbon.
Thank you, Bennett. Now I will be walking you through our manufacturing strategy and performance from quarter 1 through quarter 4. You'll see how we scaled our production, managed capacity, responded to demand, and introduced new products along the way. Let's start with quarter 1, our foundation phase. In quarter 1, our focus was solely on setting up production. We invested in 3D printers, which gave us a fixed capacity of 24 units per day, or 1,560 units per quarter. This required a capital investment of $720,000, which is very large, but is very necessary to enable future scalability. We did not produce or sell any bikes during Q1, since this was strictly a setup period. However, this investment positioned us to launch full-scale production in quarter 2. In quarter 2, we officially launched production. Our operating capacity was 780 units per quarter, and we utilized 100% of that. We produced 3 bike models: the Apollo, the Endeavor, and the Rover. As you can see, the cost breakdown below, the unit costs were relatively high, but this is partially due to low economies of scale. And in total, we produced 780 units, but the total demand across all bikes was 1,986 units, leaving about just over 1,200 units unfulfilled due to stockouts. We chose to not have any overtime in Q2, which did help us keep our labor costs stable. However, this decision did limit our ability to respond to the high demand. This quarter showed us that our demand forecasts were a bit conservative, and we learned that we need to significantly ramp up capacity for our future quarters. That's why we committed to increasing our fixed capacity by 16 units per day for Q3. Q3 was our major turning point. First, as I mentioned, we increased our fixed capacity from 24 to 40 units per day. This brought our max quarterly output to 2,600 units, and we also activated 1.87 hours of overtime per day, which gave us an additional 532 units of capacity. Our total operating capacity reached about 3,128 units, and we also utilized 100% of that again. In regards to projected demands, as you can see, we were a lot more accurate with our projections, leading to overall less stockouts. We also launched a 4th bike, Rover Plus, to expand our product line and capture more of the recreational market. Demand increased across all all of our products, and the total net demand reached about 3,517 units, and we were able to produce just over 3,100. So our stockouts were about 389 units, which is about 75% less than the previous quarter. In quarter four, this was our most complex and challenging quarter yet. We introduced two new bikes, the Endeavor Plus and the Eclipse. To support these new additions, we increased our fixed capacity to 64 units per day and brought our operating capacity to about 62 units per day. We also ran 4 hours of overtime per day, generating just over 2,000 units of extra capacity. As you can see in the bottom left, we were once again a bit conservative with our demand projections, and the key issue for this was that our forecasting model didn't fully account for the momentum gained from our new product launches. So in hindsight, we probably should have used the spike in Q3 demand as a stronger signal and adjusted our projections accordingly. Total demand surged to just over 7,000 units, and we managed to produce just over 6,000, so we hit 100% utilization again for the third quarter in a row. Despite producing more than double the amount from Q3, we also experienced just over 1,000 units in stockouts, highlighting how strong our demand had become. This quarter taught us a lot about the overall limits of scaling with overtime and the importance of aligning capacity growth with projected demand. Overall, over these 4 quarters, we were able to go from zero production to a fully scaled 5-bike product line. We invested heavily in capacity, overtime, and adapted to higher than expected demand while managing costs. Now I will pass it off to. Thank you.
One big decision that we had to make at the very beginning of the year was what sales channels we wanted to use. Like all decisions, each sale channel had a trade-off that made it much more difficult to decide. In the end, for quarter one, we chose to open 2 stores, one in New York City and the other in Amsterdam. Now, although both options are the most expensive to open and lease, causing a combined cost of $336,000 for the quarter, they have the highest potential demand in all 3 categories. New York City's recreation has a strong demand of 9,634 in recreation, while its speed was 5,657, and its mountain bike had the highest potential demand of all stores at a very nice 7,284. Amsterdam, on the other hand, had the highest potential demand in the recreation category, possessing an impressive 11,296. Its speed and mountain categories were also strong, experiencing demand of over 7,000 in speed and just over 5,500 in mountain. We hired 10 salespeople for the 2 locations, dividing them equally to both stores, providing a projected demand of 750 units. In quarter 2, with an extra $500,000, we decided to open another store, this time in Bangalore, with high recreation numbers just below 10,000 and speed and mountain coming in at just below 4,500 and above 5,500 for mountain. We believe this to be another great investment despite the extra $97,000 it took to open. We then increased the sales force as well to 15 total, having 5 sales personnel at every location and increasing projected demand to 1,350. Now on to quarter 3. We can finally see how we did financially, and safe to say, not a bad start at all. We had total sales of 780, revenue of $980,000, and gross margin of just under $500,000. It became clear to us that we needed to add even more sales personnel, so instead of 15, we upped it to 19 and had a projected demand of over 4,000. Quarter 4 is where we really started to see some profit. With total sales of 3,128 units and a revenue of $3.7 million, we ended with a gross margin of just over $2.1 million. It was after this that we added even more salespeople, going all the way up to 27 total, with 10 in New York City, 10 in Amsterdam, and 7 in Bangalore. We also decided to open one final store up in Rio de Janeiro to continue to grow and develop. Although it added another $107,000, we believe it is necessary to grow further and become an even bigger company. This leads us to quarter 5, the final quarter, where we had over 6,000 units sold with a revenue of $7.3 million and a gross margin of $4 million. This company has grown tremendously over the past year, and we do not plan to stop. In order to fully satisfy the new projected demand, we have hired a total of 40 sales representatives to disperse to all stores, and there is high optimism for the continuation of growth throughout Q5 and for years to come. Now, with that being said, let's take a look at how we dealt with our sales force compensation. We started off with the industry average, having salaries be $18,500, the minimum health package, 1 week of vacation, and then a pension of 1% of their salary. We projected this productivity to be 75%, which was far off from the actual 63.3. Due to this, we dealt with stockouts and not enough productivity for the demand for the bikes. So we went back. We increased salary, health coverage, and vacation weeks. This helped us get productivity back to 72.8. We want our employees to enjoy their job and believe in the mission we are creating, so we want to make them the happiest we can with their benefits. So in Q4, we increased everything: salary, healthcare, vacation, and pension again. This allowed us to get to 80.1% productivity, making us the company with the highest productivity and desire to work. Our goal for coming futures is to continue to make our employees as happy as we can. In the future, we can continue offering higher salaries, the best healthcare coverage, more vacation, higher pension, and in return, our employees will continue to work hard and help us grow. So now that you understand our strategy in sales and human resources, Ellie is going to explain our marketing and advertisement campaign.
Thanks, Wes. Our goal was to create 3 distinct ad campaigns that highlights the strength of each bike: Apollo, Endeavor, and Rover. Rover focuses on comfort and safety, ideal for casual riders and families. Endeavor targeted mountain bikers, showcasing rugged terrain and trail performance. And Apollo was designed for speed enthusiasts, with a sleek and elite look that positioned it as a top performer in the global market. Each ad used bold imagery and targeted taglines to clearly communicate value at a glance. We grounded our creative strategy in consumer media preference data. For Apollo, we promoted the lightweight carbon frame and placed it in high-performance publications. Endeavor featured earthy visuals and trail-focused design to appeal to riders seeking durability. And for Rover, we kept the tone light and approachable, leaning into safety elements like reflector coverage and upright posture. The ad performance confirmed our marketing direction. Apollo buyers valued elite aesthetics in biking and business media. Endeavor's audience responded best to rugged, action-oriented visuals, and Rover users connected most with friendly, lifestyle-driven designs. As we learned more, we refined our approach. Apollo doubled down on speed messaging and premium positioning. Endeavor added more terrain-focused visuals to reinforce the trail toughness it provides, and Rover's strong initial performance led us to enhance comfort features to widen its appeal. By aligning our messaging with audience insights and refining our design strategy, we successfully positioned each bike to resonate with its target market and to strengthen our brand across all segments. Now Sophia is going to be taking over.
Thanks, Ellie. Now I'll be talking about the accounting portion of our presentation. Starting with the cash flow statement. In Q1, we officially opened our first bicycle store, which marked the beginning of our operations. We heavily invested in production capacity and had initial expenses like research development and store expense. To support this launch, we raised capital through a $1.5 million increase in common stock, positioning us for future growth. I created a bar chart to show the operating activities for Q2 through 4. If we take a look at the advertising, marketing, and shipping costs, they increase slightly each quarter because of the new bike models we introduced. Now let's take a look at the more dramatic bars on this graph, starting with revenue. Each quarter, our unit sales consistently increased. We launched 2 new bikes in the Q4, the Endeavor Plus and the Eclipse. While this led to a slight decline in sales for our existing models, the revenue generated by the new bikes more than compensated for the drop, resulting in a substantial net gain. Production costs rose as expected for each new bike we introduced. Now, if we take a look at the yellow bar representing net operating cash flow, the jump between Q2 and 3 is mainly due to a major increase in revenue, rising from over $900,000 to over $3.7 million. Despite higher expenses, Controlled growth kept costs in check, leading to a stronger cash flow. Net operating cash flow didn't significantly rise in quarter four due to higher costs from opening a new store, increased income taxes, and rises in advertising. Despite these expenses, we believe the strategic investments made in this quarter will drive stronger performance in quarter five and beyond. And here's another graph that depicts our growth over the past 4 quarters. Now I'm going to pass it on to Thomas with the finances.
Thanks, Sophia. So this slideshow shows the stock issuance history for our executive team. In the first quarter, we issued about 15,000 shares of common stock at $100 per share, raising $1.5 million. And then in quarters 2 and 3, we issued an additional 5,000 shares each quarter at the same price, raising another $1 million combined. In total, across the first 3 quarters, we've raised $2.5 million through equity financing. This strategic rollout helped us secure capital while maintaining strong ownership within the executive team. We also considered using a certificate of deposit to earn interest on our cash reserves. However, we ultimately decided against it. The available interest rate was just 1.5%, and locking up our funds would have limited our flexibility. We felt that the opportunity cost of not having immediate access to cash, especially in the event of an emergency or unexpected expense, outweighed the minimal returns. Maintaining liquidity was a strategic choice to ensure we can respond quickly to operational needs or seize growth opportunities. Over the past 3 quarters, Voyage Carbon has consistently led or performed at the top across nearly all key areas of the balanced scorecard. Let's take a quick look at each perspective. From the financial perspective, financial performance jumped from 15.15 to 146.25 from quarter 2 to quarter 4, which is significantly above the industry average each quarter. We maintain maximum financial performance across all 3 quarters, which is a strong indicator of our revenue generation and cost control. From the customer and market perspective, it rose steadily from 0.249 to 0.503 and outperformed the industry average. In internal processes, our manufacturing productivity improved from 1.0 in Q2 to 0.75 in Q4 after peaking at 0.813, showing high efficiency and operational consistency. And in human resource management, we showed steady improvement each quarter, ending at 0.809, which was topping the industry performance. Voyage Carbon showed strong balanced growth across financial, operational, customer, and developmental areas. We've stayed above industry averages in nearly every category, and by Q4, led the industry in total performance, financial metrics, and internal management. Now I'm going to give you to Bennett to wrap it up.
Thanks, Thomas. Very well put. So as we've grown, we've learned a few key lessons. I'll go back. Yeah. First, we have to be aggressive. In our space, momentum matters. Second, Salesforce happiness is everything. We can't grow without motivated people behind us at point of customer contact who are truly passionate about our brand. We've also learned that failure is part of innovation. We know we weren't perfect, but we can look at what we did in the past and not make mistakes going forward and improve upon everything that we've done. Don't fear mistakes, learn from them. And finally, we've taken notes from our competitors and past missteps. That humility has kept us sharp and constantly evolving in an ever-changing landscape. So where are we headed? First, we're scaling. We want more bikes, more inventory, more output. Voyage Carbon is going to take over the world. We're expanding our fixed and operating capabilities in order to meet that demand. And to support this, we will grow our sales team and continue to diversify our models and improve upon all of our flagship models, as well as introducing new, exciting models into our sales line. And most importantly, we're investing in better benefits and incentives for our sales force, because when they win, we all win. Thank you so much for coming to listen to our journey as a company, and we hope to see you at your local bike shop.